Let's now look at how we account for new issues of common stock. Our primary objective in accounting for the issuance of common stock are 1. To identify the specific source of paid-in capital, and 2. To maintain the distinction between paid-in capital and retained earnings. You should know that when a company issues common stock, the only account that is affected by that is paid-in capital, and cash, of course. When a company issues par value common stock for cash, the par value part does not indicate the stock's market price. The cash proceeds from issuing par value stock may be equal to or greater than the par value. That is, the par value is the face value of the stock, but that does not mean it's the market value of the stock. When a company records the issuance of common stock for cash, it credits the par value of the shares to the common stock and records in a separate paid-in capital account the proceeds, that is, above or below the par value. So if they sold a stock for, let's say, $12 that had par value 10, they would record in common stock 10 and in premium on common stock 2. In recent years, however, companies issue no par value stock with the stated value on the stock. For accounting purposes, then we just treat the stated value in the same way as the par value. That is, we record in common stock exactly what we received for that common stock. Now we look at preferred stock. That is a kind of stock that the company is trying to attract a larger segment of potential investors. And that way they offer a preferred stock. Preferred stock has contractual provisions that give it preference or priority over common stock in certain areas. Typically, preferred stockholders have a priority in relation to dividends and to assets in the event of liquidation. However, they sometimes do not have voting rights. Approximately 6% of USA companies have one or more classes of preferred shares. The journal entries for preferred stock transactions are similar to the entries for common stock. When a company has more than one class of stock, each paid-in capital account title should identify common stock or preferred stock. Now, just like for common stock, preferred stock can be issued either at par value or with no par value. Now, in the shareholders' equity section of a company's balance sheet, the company will show preferred stock first and then common stock later. The reason being is that preferred stockholders have preference in terms of dividends and liquidation. Now we're going to look at accounting for treasury stock. You should know that treasury stock is a corporation's own stock that has been reacquired in the marketplace by the corporation, and the corporation is going to hold it for future use. What may be that future use? Well, a corporation may acquire treasury stock in order to reissue the shares to the management and officers and employees of the company under a bonus or stock compensation plan. They may want to have additional shares available for use in acquiring other companies. They may want to reduce the number of shares outstanding and thereby increase the earnings per share on each share and the market value of those shares. And a less frequent reason for purchasing treasury shares is to eliminate hostile shareholder takeovers. Companies are well aware that by buying their own stock, they are signaling to the market that the company's management believes that the stock is underpriced, which they hope will enhance the market price. The purchase of treasury stock is generally accounted for by the cost method. This method derives its name from the fact that the treasury stock account is maintained at the cost of the shares purchased. Under this cost method, the company increases, that is, debits, treasury stock by the price paid to reacquire those shares. When they issue those shares, treasury stock decreases by the same amount. Companies show treasury stock on their balance sheet as a deduction from total paid-in capital and retained earnings. The company's balance sheet then discloses both the number of shares issued, let's say 100,000, and the number in treasury stock, 4,000. The difference is the number of shares outstanding, in this case 96,000. That is that the term outstanding stock means that the number of shares of issued stock that are currently being held by stockholders.